Hello and welcome to Wealth of Advice Market Update recorded on the 9th of September 2022. So as we open up with market news on this client update, the first thing we have to cover off is obviously the fact that the Queen passed away yesterday. Whilst this won't have any sort of impact on the markets, because although she's regarded as the leader of our nation, the longest serving monarch in our history, she didn't really have any impact on what goes on in world markets and such like, and King Charles III, he won't either. However, the chart that I'm putting on the screen now just shows kind of what's happened over the reign of Queen Elizabeth II from when she took over 70 years ago, which is a hell of a long time obviously, and look at that line of how the markets performed over that 70-year period. Much calmer until we got to the mid to late 80s. And then as you look at the last decade, where everything looks like a heart rate monitor flying up and down, the question has to be asked, why are markets so much more volatile now? Well, there's a lot more events seem to be going on in the world right now. We've moved into a much more globalized world. The world's a much smaller place, we often hear. And if you just look at the latter half or the latter third of that chart you can see on the screen there, we've had global financial crisis, we've had Brexit, obviously COVID, etc., as well as sort of the war in Ukraine and everything we're experiencing now, and markets are much more volatile. That said, even though we've had these massive volatile periods, if you'd been invested in UK equities over the period that the Queen had been in power for, you would have made an 11.7% return on average over that 70-year period. So that's an absolutely fantastic return. Again, just focuses on the fact that the longer you're invested, the better your returns will be. And as you're invested for a longer period of time, those short-term periods of volatility kind of wash themselves out. One thing to point out as well, when the Queen came to power in 1952, only 3% of the UK population owned shares. Now there's around about 80% of the UK employees will invest in shares via pensions. We have auto-enrollment schemes now, which has an 80% uptake, which is why we quote that figure. But the world has changed so much. In 1948, 48% of UK GDP came from production and construction. By the year 2000, this has reduced to 21% and probably reduced further. So we've been looking for some key stats as to what's changed over that period of time, but everything changed. She'd been in power for so long. Our new Prime Minister, who's only been Prime Minister for a matter of days, she announced that energy bills are going to be capped for the next 2 years for consumers. So every household bill will be capped at £2,500 from October. The table that you can see on the screen now just highlights some of the key bullet points that was made in Liz Truss's announcement. There's going to be help for business, which that'll be good for markets. FTSE's gone up again today. The pound has strengthened on the back of this, even though the pound hit all-time lows against the dollar earlier on in the week. We'll come on to this a little bit more as we go through, but the pound hasn't weakened as much as the dollar is strengthening. The dollar is strengthening against all currencies. The pound is weak in general, but as I say, the dollar is strengthening up. But this announcement has helped the pound today. There's going to be an energy supply task force negotiating long-term contracts and seeing if they can reduce the price they charge to businesses. That will be good. Fracking's back on the table, so to speak, and if fracking can be done with the approval of those in the local community and it's to the benefit of everyone, then fracking can go ahead. So lots came out of that yesterday. There was also discussions that the planned increases in corporation tax from 19% to 25% is likely to be cancelled. National insurance increases that came in recently, they're going to be reversed. And also the VAT amount that we pay is going to be reduced by 5%. So hopefully those are all things which will boost profit and growth in companies, and the government's belief is that will then trickle down to be more money invested in our economy, make our economy grow, and overall we'll be all wealthier people as a result. We'll see how that unfolds. The new Chancellor Kwasi Kwarteng will hold an emergency budget later this month, and again we'll be keeping an eagle eye on any announcements he makes to see hopefully how they may affect you as the end consumer, but also how it's going to affect markets. And hopefully we end this year in a much more positive note than the first 6 months, which were absolutely terrible for markets. So hopefully actually having a government back in place, a new Prime Minister, a new Chancellor, that we may see some positive stories come through and markets will grow thereafter. So the next major part of what's going on in world news is energy prices. Obviously the war in Ukraine, which we've been well aware of now for the last 7 months almost, that's been raging on for. The big outcome of that from the point of view of each individual consumer in our country has been this constant message that the reason why prices etc. are going up is because of the war in Ukraine, and Russia exports so much of the world's gas that we're going to have big problems. Russia announced recently that they've closed the Nord Stream 1 gas pipeline and have threatened to keep it closed until sanctions end. European countries have been stockpiling gas ahead of the winter, but we still believe there's going to be problems across Europe, especially. The EU are already talking about certain blackout periods, and that could be a big issue. But some people are also saying that this has been over-exaggerated and the EU are just getting prepared for what's happening next. But if you look at the table, the chart that we're showing on the screen right now of natural gas prices, and this is taken from the BBC website on the 8th of September, you can see that gas prices have been coming down again in recent weeks, and they fell by 3.8%, 48% yesterday. They're still higher than where they were in early parts of the year. It did spike right the way back up in recent weeks, but they are coming back down. So hopefully the price of gas continues to come down. The price of crude oil has also gone down. Put that table on for you there now. So you've seen at the petrol pumps in our country, when you put petrol in your car, the price of that got up to almost £2 a litre, some places higher than £2 a litre. That's come right the way back down. So hopefully this real impact of what Russia was doing and causing problems with the gas and oil prices, it has spiked and it is coming back down, which obviously also then feeds into the story that these really high inflation numbers that we've been seeing may have perhaps peaked. So I mentioned up at the start of this week's update that the pound this week fell to its lowest level against the dollar since 1985. The graph that we see on the screen now has shown where the pound has gone over that period. As many people watching this might know, I love going on holiday to Florida, and the pound weakening has crippled us recently because everything just feels like it costs so much more. What is really coming out of this is the fact that the dollar has strengthened. So although people are asking the question, is this weak pound a reflection of the poor performance of the UK economy and our future outlook? Yes, that is a part of it. But as we have entered this period of high volatility, worry around the world, the war in Ukraine, the dollar becomes a safe haven. So big investors, big, huge sovereign wealth funds, etc., they will push a lot of their money into the dollar and leave it there. So therefore the dollar strengthens, and at the same time other currencies weaken against the dollar. So yeah, as you can see, going back to that period in the 80s when the pound was so weak against the dollar, it did recover. So hopefully we can see similar recovery on the pound in the not too distant future. Again, mentioned new Prime Minister, new government, hopefully 2 years left of this parliamentary term. As I said, I'm not necessarily endorsing the current Prime Minister at all. I just think if the Tories have done one thing good in their history, it's win elections. They now know that they've got 2 years to win this next election, so they need to do something which is hopefully going to boost the UK economy. That might in turn boost the pound. So when we are talking about how weak the pound has been, it is interesting to note that it is only 3% weaker than the euro over the last sort of 12 months. Although it has fell against the dollar, everything has, but only 3% against the euro isn't a massive amount. The Federal Reserve in the US has recently increased interest rates faster than the UK, which is another reason why the pound has strengthened. The Euro Central Bank, they increased their interest rates by 0.75, I think it was earlier on this week, which is a massive increase for them to take them well above the zero. So you might expect the euro to strengthen on the basis of that. But we are expecting the Bank of England to increase our rates next week, again by potentially as much as 0.75 ourselves. Again, in this hope to fight inflation, you try and raise interest rates. So there's a lot going on with regards to currency, and that causes volatility in markets as well. So it's certainly something to keep an eye on as to what the Bank of England's going to do next week. So we have spoken about inflation quite a bit over the last few months. If you go back to the market updates that we do in the early part of the year, we were saying that every fund manager we were speaking to was saying the big risk of 2022. This was kind of ahead of the Ukraine invasion from Russia. go back to January, beginning of the year, what we were really being told was inflation is going to be the problem as we emerge from lockdown, people sitting at home for 12, 18 months with money coming in from furlough payments, bounce back loans, hadn't spent money of their own. People were getting out there during 2021, they were spending money, it was going to bring prices up. So kind of the inevitable happened, and the inflation we saw happened. Obviously the problem was exacerbated by what went on in Russia and Ukraine, but then you start seeing stories like you can see on the screen now. So this was Goldman Sachs. One of their guys said they expected UK inflation to rocket to 22%. What a great headline. As you can see, it was a headline that was jumped upon none other than the Daily Mail that were advertising there. The Daily Mail, who love people to click on their stories all the time. And it was a sensational headline, inflation to get to 22%. This was based on the assumption that the government wouldn't step in, wouldn't put energy caps in place. It was expecting energy prices to go well above £3,500 a year and beyond. So quite clearly that story is a rubbish story, it's fake news. But you don't see the Daily Mail running a story today saying, well, actually as a result of what the Prime Minister announced yesterday, that UK inflation isn't going to rocket to 22%, they just left that story there. I know it was from 31st of August, so it was only, 10 days ago that they ran this story. But it's clearly not going to happen, and it just shows that this problem with inflation that gets into people's heads when you see stories like this, proposing inflation is going to be much higher than what it actually went to, may cause people to stop spending money, which in turn brings down the economy. So when we talked about how the economy was doing, we were told that the UK is probably already in a recession. Well, already this morning we're reading headlines saying as a result of the government putting these energy price caps in place, that this may push back the recession into next year. So we shall wait and see on that. But personally, from everything that we've been reading, been told, I do believe that in the UK and in the US we now are at a period where inflation has peaked. And let's not forget, inflation is based on the value of prices 12 months ago to today, so you're always comparing a 12-month period. So it's logical to expect that as the higher prices that we saw coming in at the end of 2021 and now 12 months kind of behind us and we move on, that inflation should peak and fall away. But as I say, we'll keep looking at that. Just to reconfirm what's happened, European Central Bank increased rates by 0.75%. The US Federal Reserve met recently and they're saying that they are going to keep raising interest rates until they believe they've got the job done. The job done being getting inflation under control. So if inflation has peaked over there, you would maybe hope that they would stop raising rates so much. A fund manager we heard speak at an event in June said, and a typical American phrase, that once the Fed stops raising rates, you will see a rip your face off rally, which what interprets that mean into English is that markets are going to rise once they believe rates aren't going to be going up too high. So maybe that you see the US raise interest rates when they meet again on the 20th of September. There is the expectation in the markets that that will raise by 0.75%. If it was lower than that, then you would see a good market jump maybe after that. Clearly, if it was a higher rate, then the markets might not like it. And the expectation is that we will see both the UK and US interest rates continue to be increased to get to a level of around about 4%. So politicians will obviously come out and explain that they don't want to see the general public affected by rising interest rates and such like, and they'll want to create measures to help people through a poverty crisis, cost of living crisis, etc. But it should always be noted that the central bank will want rates to get back to a good level, which 4% would be a good level. Because once they do have it back to 4%, they then have that lever that if we ever get into financial difficulty again in the future, another big recession, another COVID type event, then you can reduce interest rates to spark a recovery. So it's perfectly normal to see banks to try and get rates up to 4%, and that's certainly where we're expecting to see them going. So I'm now coming to the part of the presentation where we look at how markets have been performing recently. As you can see, this market performance just looks at what's gone on over the last 3 months. We had explained on the last market update that once we got out of that horrific period of mid-June, that markets rose nicely, and as we got towards the mid to late part of August, Big investors must have looked at the returns they've made over that previous 5-6 week period and took some cash off the table, so to speak, because markets went down again as we got into the last week of August and the first week of September. But we shouldn't look away from the fact that since 7th of June, so 3 months ago, that the S&P 500 is up 5.4%, the MSCI World Index is up 2.7%, the FTSE 100 minus 3.6%. Part of me might say, well, that's to be expected in the UK because we've gone through this limbo period of having no Prime Minister and no cabinet really doing anything. There is an age-old saying of go away in May, come back on St. Ledger Day. From an investment point of view, which has stood the test of time, if you look at market performance from the period you'd see on there, June through to August, UK market has always underperformed, and then once we get back from our holidays, Parliament resits in September, we get some new policies, so you hopefully will see a better end of the year from the UK market point of view. So let's see if that happens this year. When we look at market performance since the start of 2022, as you can see, it is absolutely all over the place. The FTSE 100 is the best performing index of the three we're comparing on there, which is plus 1% over that period of time. Again, boosted by your Shells and BPs and the mining stocks and such like, which have made good numbers this year. The S&P 500 just about breaks even on 2022, which if you look back to mid-June, the S&P 500 on there is the green line, which is the one which was the worst performer mid-June. It has come back spectacularly since then as people realise that your Amazons, your Microsoft, etc., big American stocks had been oversold and the market saw them as cheap investments and got back in there. The MSCI World Index there is minus 3% so far during 2022. So very volatile period as you can see from the chart there, backed up with what you've seen in world news as to what's been going on all over the place. But as ever, when we look at the long-term returns, we look at the 5-year market index performance. If you'd been invested in the S&P 500 over that 5-year period, you're up over 100%, 101.73%. The MSCI World Index over the same period, almost 70%, 69.95%. And the poor little FTSE 100 right the way down there over that 5-year period is 18.65%. So we all know the reasons why the FTSE was the worst performer over that time. Obviously, fears over what Brexit was going to do. So one of the things our parting Prime Minister, Mr Johnson, said the other day was that he got Brexit done. Well, I don't think anything has been done yet in so much as what's happened after we've left the EU. This is what we need to see coming through the next 2 years of this Parliament, to see UK markets grow as some positive policy decisions that's going to help UK PLC. I certainly think that the proposal of keeping corporation tax at 19% instead of rising it to 25% is a positive thing for UK companies. It makes our companies more attractive to invest into. So hopefully we see the UK market over the longer run catch up with the S&P and the MSCI World Index on that particular chart. Thanks again for listening to another Wealth of Advice market update. Hope you found it useful and informative. And if you have any other queries or questions, please don't hesitate to get in touch. Either email, telephone the office, whatever's best for you. Thank you.